Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers.
Absolutely. Let's get into it.
So I want to welcome you to today's deep dive because we have a mission today. And that mission is essentially an introductory masterclass on reading the true matrix of the global economy.
I like that phrasing, the matrix.
Right, because, if you want to know what the stock market's going to do, say, 6 months from now, you really shouldn't be looking at a stock chart. You should be looking at the literal receipts for concrete or copper.
Exactly.
Seriously, if you're listening to this and you've ever stared at your brokerage app, just watching the little lines bounce up and down and felt like you were always one step behind the smartest money in the room, well, that's because you are.
Yeah, you definitely are. And what's fascinating here is that it completely reframes how you look at the markets. Well, the core thesis we're exploring today is that the vast majority of retail investors are just fundamentally distracted. I mean, they are captivated by this illusion of daily price action.
The green and red candles.
Right, exactly. But the massive institutional players, the sovereign wealth funds, the multi-trillion-dollar asset managers, they aren't sitting in a dark room obsessing over a 5-minute chart on a screen.
They're doing something else entirely.
Yeah, they are tracking a hidden, undeniable signal. They're looking at structural corporate balance sheets. Specifically, they're obsessing over institutional capital expenditures.
Okay, but I want to stop you right there for a second. Because what you're saying implies that almost everything an everyday trader uses to, analyze a stock might be entirely backward.
Oh, it is. It really is.
I mean, we're talking about all the standard technical analysis tools that people rely on literally every single day. Why is that approach so flawed?
Think about how a typical retail trader is taught to operate, right? They spend hours drawing these little lines of support and resistance on a price chart. They're looking for RSI divergences, or they're waiting for some moving average crossover. But here's the massive problem with those tools. RSI, which is the relative strength index, these are all mathematical formulas based entirely on trades that have already happened.
Past tense.
Exactly. It's a hyper-reactive way to view the world. You are literally just doing math on the past. The fundamental truth here is that price is a lagging indicator.
Meaning, by the time the price of a stock actually spikes on your screen, the monumental decisions that caused that spike were actually made months or even years ago.
You've hit the nail on the head. Those green and red candlesticks on your screen are not the cause of an economic shift. They're just the thermal footprint left behind by a much larger invisible force.
A thermal footprint. I like that.
Yeah, and that force is real, physical, institutional capital flow. I mean, the giants of the financial world do not base their multi-billion-dollar allocation decisions on whether a stock chart has formed a cute little cup and handle pattern.
I mean, it is pretty funny to picture an executive at a massive fund looking at a 15-minute chart and saying, oh, look, the momentum indicator is slightly oversold. Let's go ahead and deploy $50 billion into the energy sector.
Right. It just doesn't happen. They base those massive decisions on long-term industrial cycles. They look at real-world physical constraints and deep structural accounting data.
But let me push back on that for just a second, just to play devil's advocate.
Sure.
Isn't the current price of an asset the ultimate objective truth of what that asset is worth right now? I mean, we're always told the market is highly efficient.
Well, it's efficient at pricing in known information, sure.
Right. So why should you or I go digging through slow, boring financial reports that only come out every quarter when the price on my screen is updating every single millisecond? Doesn't the price tell me everything I need to know?
That is such a common argument, but it fundamentally misunderstands the objective. If your goal is simply to react to what just happened 5 seconds ago, then yeah, go ahead and stare at the price. But if your goal is to anticipate the market, to basically predict the future before it becomes public euphoria, you have to follow the money before it hits the news cycle.
You have to get ahead of the footprint.
Exactly. You have to look at the structural, physical reality of the companies that actually drive the economy. And to do that, you really have to learn to speak the language of corporate accounting.
Okay, let's unpack this then. If price is just a lagging thermal footprint, where do we actually find the footprint before the rest of the market sees it?
We look at the expenditures.
Right, because our sources highlight a very specific concept that acts as this ultimate truth teller. So let's treat this like an introductory finance class for the listener. Break down the actual mechanical difference between OpEx and CapEx.
I'd say it is arguably the most important distinction in all of finance. So when a major company spends money, that outflow of cash is basically categorized into one of two buckets.
Okay, bucket number one.
The first is OpEx, which stands for operational expenditures. This is just the day-to-day cost of keeping the business alive.
So like paying employee salaries, keeping the lights on in the office, buying software subscriptions.
Yeah, all the standard running expenses. And mechanically, OpEx is deducted entirely from the company's profits in that current year. It's money out the door today to keep the business running today.
Makes sense.
But CapEx, which is capital expenditures, is a completely different financial beast. This is money spent on acquiring, maintaining, or upgrading massive physical assets.
Oh, wow. Okay, so bigger scale.
Much bigger. We're talking about building new manufacturing plants, buying heavy industrial machinery, or, constructing massive data centers.
So because it's physical infrastructure, the accounting rules actually treat it differently.
Exactly. Because these massive investments are designed to generate value over a span of, say, 5, 10, or even 20 years, the accounting rules say you don't just deduct that massive expense from today's profit.
Where does it go then?
That spending goes straight onto the company's balance sheet under a category called PP&E. That stands for property, plant, and equipment. And once it's there, it is depreciated slowly over its useful life.
I think an analogy might help ground this for everyday life.
Yeah.
It's like, imagine you're watching a CEO on a financial news network, right?
Okay.
They're wearing a nice suit, they have a great smile, and they tell the interviewer, "We're incredibly optimistic about our new product line."
A classic line.
Right, but that statement is entirely verbal. It's basically a corporate New Year's resolution. It's incredibly cheap to say, and it's easily broken. It's like me saying, I'm going to go to the gym 5 days a week this year.
Sure you are. We've all been there. Talk is incredibly cheap in corporate finance, and honestly, CEOs are paid very well to be optimistic.
Exactly. But if that exact same CEO signs off on a 40% increase in their CapEx budget, that is no longer just talk.
Not at all.
That is the equivalent of signing a non-refundable, multi-billion-dollar contract to actually build a brand new gym from the ground up, buy all the equipment, and physically pour the concrete.
That is a perfect way to look at it.
They can't just change their mind and take that back the next morning. It is the mathematical, non-verbal expression of absolute conviction.
I love how you phrase that, the nonverbal expression of absolute conviction, because that's what CapEx is, institutional conviction quantified.
Right.
When a corporation validates a massive surge in CapEx in their quarterly filings, they are writing checks that lock them into a specific physical reality for the next decade. It's an irreversible commitment.
You literally cannot unpour concrete.
Exactly, and that is why it is the most reliable leading indicator in the entire market.
Okay, so the concrete is poured, the massive checks are written. But that money doesn't just, vanish into a black hole. Once a giant corporation makes that mathematical commitment, how does that money actually move through the real economy?
This brings us to the core economic principle behind what professionals call the institutional CapEx tracker. And the underlying principle is beautifully simple, but incredibly powerful.
Let's hear it.
One company's massive capital expense is another company's guaranteed future revenue.
Okay, I need to see this in action. Give me a concrete example of this domino effect. Walk me through how this cascades through the market.
Let's use the current global build-out of artificial intelligence infrastructure. It is basically a perfect textbook map of this fundamental domino effect.
Perfect.
The cascade starts at the very top, at level 1, with what the industry calls the hyperscalers.
The big guys.
Right. Think of the absolute apex tech giants, Microsoft, Google, Amazon Web Services, Meta. Let's say we dig into their financial reports and discover that their combined CapEx dedicated to building new data centers is jumping from, say, $100 billion to $150 billion.
Yeah, there's an extra $50 billion suddenly injected into the system.
Yeah.
But what does $50 billion actually look like? Because it doesn't just float into the literal cloud.
No, it flows outward, sequentially and predictably. That 50 billion cascades down the supply tiers. So tier 2 represents the semiconductor designers.
The ones making the chips.
Exactly. The companies actually architecting the high-end AI chips. They get the first wave of that hyperscaler money. But it doesn't stop there. Those specialized AI chips draw an enormous amount of power, and as a result, they run incredibly hot.
Oh, right. You can't just put a regular desk fan on them.
Not even close. So the capital then flows to tier 3. The infrastructure and liquid cooling providers. These are the companies building the specialized cooling lakes, the advanced thermal management systems, the heavy-duty server racks.
Wow.
But the cascade still isn't finished. You finally hit Tier 4, which is the raw physical materials and energy base. I mean, to physically wire those new data centers, you need an unprecedented amount of copper.
Yeah.
And more importantly, you need power.
And not just any power, right? A data center running massive AI models can't just shut off when the wind stops blowing or, the sun goes behind a cloud.
That's the critical connection. They need steady, uninterrupted 247 baseload power. And currently, the most viable source for that massive, reliable energy is nuclear.
Wait, really?
Yeah. So suddenly, a CapEx decision made by a tech CEO in Silicon Valley cascades all the way down to drive a massive surge in demand for uranium and nuclear energy providers.
That is a huge aha moment. Because if I think about the average retail trader, they see the news that a level 1 tech giant is investing heavily in AI. They pull up their brokerage app, and they immediately buy whatever trending AI software stock is flashing on the news ticker.
Yep, they're buying the headline.
Right, so retail just buys the AI stock.
And that is exactly how the retail trader becomes the exit liquidity for the smart money. The fundamental professional trader operates entirely differently.
How so?
By the time that level 1 investment is being talked about on evening television, the price of that tech stock is already priced in. It's over. But the smart trader was monitoring the CapEx data.
So they were already ahead.
Way ahead. By calculating that level 1 capital injection from the hyperscalers months ago, the professional was already taking positions in the Tier 4 copper producers, the uranium miners, and the Tier 3 cooling system manufacturers half a year earlier.
Because they anticipated the domino effect long before the first domino actually fell.
Exactly.
So what does this all mean for the listener? If you want to stop being the person reacting to yesterday's news and start being the person tracking the dominoes before they fall, how do you actually build this tracking system? What is the professional playbook here?
It requires some discipline, but the mechanics are surprisingly straightforward once you know where to look. Step 1 is to identify the drivers.
Okay, step 1.
For whatever macro sector you want to analyze, you need to list the 5 to 10 apex companies that basically dictate the pace of investment for that entire industry.
So, if you're analyzing AI, it's the tech giants we just talked about. If you're analyzing the global transition to green energy, it's probably the major national utilities and sovereign state funds.
That's right. You find the apex predators. Then step 2 is surgical data extraction. And this is vital. You must completely ignore the simplified news summaries and press releases.
Don't read the PR.
Never read the PR. You have to go directly to the source, which in the U.S. market is the SEC's EDGR system. You are looking for the official quarterly reports, known as the 10Q, and the annual reports, the 10K.
Okay, wait. I have looked at a 10K before. They are literally hundreds of pages of dense legal jargon, risk factors, and tiny footnotes. I mean, do you expect people to read all of that just to find a signal?
Not at all. That's why I use the word surgical. You skip the management commentary, you skip the marketing fluff and the forward-looking statements. You go straight to the financial tables.
And here's where it gets really interesting, because our sources are extremely specific about which document to look at. A lot of people might assume you go straight to the income statement to see how much money the company is making.
Which is a mistake.
Right. We aren't looking at the income statement. We are going straight to the statement of cash flows. Why is the income statement flawed for this kind of tracking?
Because the income statement can be, well, heavily massaged. It relies on accounting principles that leave a lot of room for interpretation.
Like what?
Well, management teams can use subtle accounting tricks to make their current earnings look much better than their actual reality. For example, you'll often see a metric called adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Which always sounds to me like a company saying, look how incredibly profitable we are, as long as you ignore all of our massive legally binding bills.
That is essentially what it is. Or management might artificially stretch out their depreciation schedules.
How does that work?
Say they buy a billion-dollar machine and say it will last 10 years. They take a certain hit to their profits each year. But if they suddenly change the accounting to say it will last 20 years, their yearly profit magically looks higher on paper, even though nothing in the real physical world changed.
So the income statement is totally malleable. But the cash flow statement?
The statement of cash flows is the most brutally honest document in corporate finance. It strips away all the accounting theory and simply tracks the actual liquid money entering and leaving the company's bank accounts. You literally cannot fake cash.
It's just the bank asking, did the check clear?
Precisely. So You open the statement of cash flows and you scroll down to the specific section titled Investing Activities.
Okay, investing activities.
Under that heading, you are looking for a line item that will usually be called capital expenditures or purchases of property, plant, and equipment. That is your golden number. That is the unfakeable proof of conviction.
Okay, so I extract that golden number. What am I actually doing with it? Am I just looking to see if the number went up from last year?
You're tracking 3 core metrics in a simple spreadsheet. First, you calculate year-over-year CapEx growth. Is the absolute dollar amount they are spending on physical infrastructure accelerating?
Makes sense. Metric 2.
Second, you look at the CapEx to revenue ratio. So, what percentage of their total sales are they choosing to plow back into building out their physical footprint?
Okay, and the third.
And third, you track the lagged supplier correlation. You map that massive CapEx growth from the level 1 giants against the future revenue of the tier 3 and tier 4 suppliers we talked about earlier.
Tying it back to the dominoes.
Exactly. When the apex predator's CapEx spikes, you know a massive wave of revenue is about to hit those lower tier suppliers a few quarters later.
That is, I mean, it's a completely different way to see the world. It's like having a map of tomorrow's economy today. But as amazing as this sounds, it raises a huge red flag for me.
What's that?
Tracking all this money flowing into a sector sounds incredibly bullish. It's an intoxicating wave of capital. But we all know nothing goes up forever. Is there a dark side to these massive, multi-billion-dollar investment booms?
There is an incredibly dark side, and this brings us to the most crucial aspect of professional risk management. Because quantitative fundamental analysis isn't just about finding what to buy, it's about knowing the precise moment you need to evacuate.
Okay, let's get into the evacuation plan.
This brings us to what's known as the cyclical overcapacity trap.
The overcapacity trap. Let's explore the mechanics of that, because what goes up must eventually come down.
History shows us that massive CapEx cycles almost always end the exact same way, with a catastrophic collapse in profit margins. Here is how the trap is set. An industry becomes ultra-profitable.
Say, AI chips.
Or semiconductor manufacturing, or maybe lithium mining for electric vehicles. Because the profit margins are currently so fat, every single company in that sector decides to massively increase their CapEx simultaneously. They all want to build new factories to capture more of that incredibly profitable market share.
I think I have a good analogy for this. Let's simplify it. Imagine there's a guy who opens a food truck on a busy corner downtown. He makes the absolute best tacos in the city, and suddenly there is a line around the block. He's printing money.
Okay, I follow.
Seeing that huge line and those massive profits, 10 other ambitious people decide, hey, I'm going to take out a loan and build a food truck to park on that exact same corner.
Right. The signal they see is clear. High demand equals massive profit, so they all start investing capital.
But here's the catch. Building a high-end food truck takes time. You have to get the permits, buy the truck, build the custom kitchen. So for 6 solid months, while everyone else is busy building, that original guy is still the only one selling tacos. The lines get even longer. The hype in the neighborhood goes off the charts.
Everyone is euphoric about the local taco market.
Exactly. But then, what happens when all 10 of those new trucks finish construction and open their windows for business on the exact same Tuesday?
That Tuesday is when the overcapacity trap snaps shut. Supply instantly floods the market. The underlying demand for tacos hasn't actually changed, but now there are 11 trucks fighting for the exact same pool of customers.
Right.
To get people to come to their window, they have to start slashing their prices.
And this is where the math gets brutal.
Oh, it's devastating. Let's break down the mechanics of the math. Their profit, which is the numerator in our equation, shrinks dramatically because they had to slash prices. But the millions of dollars they collectively took out in loans to physically build those 10 new trucks, that massive capital expenditure, is the denominator.
And that huge denominator is fixed.
Yes. So you have a shrinking numerator divided by a massive fixed denominator. Their profit margins collapse to zero, and the money they spent building those trucks instantly becomes a toxic investment. They just built too much capacity.
It's the boom and the bust all rolled into one predictable physical cycle. The exact same thing happens with multi-billion-dollar semiconductor fabs or copper mines.
Exactly the same.
While they are actively being built, supply is constrained and prices skyrocket. It feels like a gold rush. But when all those massive factories finish construction and turn on at the exact same time, boom, the market is flooded. Crash.
Right.
So how can you use the CapEx tracker to see that Tuesday coming before it actually arrives? What is the mathematical emergency exit signal?
This introduces our final and perhaps most vital metric. It's called ROIC, or Return on Invested Capital. Essentially, this measures exactly what we just discussed, how efficiently a company is turning the massive amounts of capital it invests into actual bottom-line profit.
So profit divided by the invested capital, the numerator over the denominator.
Correct. So here is your evacuation signal, the precise indicator of a cyclical market top. You are watching your data extraction dashboard, and you see that the absolute CapEx spending of the sector leaders is hitting all-time historic highs.
They're pouring money into new infrastructure.
Right. But simultaneously, their ROIC begins to drop.
The denominator, the money they are spending to build, is exploding. But the numerator, the actual profit they're getting back, is stalling out.
Yes. Mechanically, it means that for every new dollar they're desperately throwing into building more factories or data centers, they are generating less and less profit. The efficiency of their capital is dying.
Wow.
This specific divergence, rising CapEx and falling ROIC, is the ultimate red flag. It means the market is entirely saturated. The food trucks are built and about to open.
Get out of the taco market.
Exactly. When you see that divergence in the SEC filings, the cycle is over. That is the exact moment the fundamental trader quietly sells their positions and exits the building.
Usually right as the retail traders are blindly pouring in.
Sadly, yes, intoxicated by the late-stage hype.
It's almost beautiful in its mathematical ruthlessness. I mean, it explains the boom and bust of literally entire global industries, whether it's railroads in the 1800s, dot-com fiber optics in the 90s, or AI infrastructure today.
Human nature doesn't change.
And it's all right there, written in black and white, hiding in the cash flow statements of SEC filings.
The physical reality is always there, long before the stock price reflects it.
Well, let's wrap this up and summarize the journey we've just been on. If you want to understand the true structural mechanics of the market, you have to move past the noise of daily price action. You have to stop treating 5-minute charts and lagging RSI indicators like they are some kind of crystal ball.
Definitely.
Instead, you go to the absolute truth, the cash flow statement. You track the massive, irreversible CapEx decisions made by the Tier 1 giants. You follow that fundamental domino effect down through the supply chain, from the hyperscalers to the raw material providers, to find the real value before the rest of the market catches on.
That's the playbook.
And finally, use the divergence of rising CapEx and falling ROIC as your emergency exit, allowing you to spot the overcapacity trap and get out before the crash.
That is the complete macroeconomic playbook. And I'd leave you with this final thought to really mull over.
Go for it.
The physical infrastructure of tomorrow's world is already written down today in dense legal filings. The money always leaves a trace long before the first cubic yard of concrete is ever poured. If you take the time to learn how to read the accounting, you are, quite literally, reading the future.
In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.